Welcome back to Marketwatch at 10:30 a.m. U.S. investors are looking out for the next batch of economic data that's going to hit the market this week. Initial jobless claims and the trade deficit today. Producer prices, retail sales and industrial production tomorrow. All these providing more hints about the health of the economy. The retail sales figures are especially important. Economists are watching closely for signs that consumer spending may slow from the levels it's been at. For a bit more detail on how that data is likely to affect the situation in the States, particularly with relation to interest rates, let's join Peter Churchouse, who's Advisory Director at Morgan Stanley, and he's in our Hong Kong studio. Peter, welcome back on the show. Thanks for joining us. Morning. The retail sales is an interesting part of this whole U.S. economic recovery, isn't it? Because during what was supposed to be a recession, we barely saw retail sales falling at all. We've been holding up remarkably well the whole time and driving the entire economy forward. Is that a good thing or a bad thing?
Well, put it this way, it's a very different recovery in this cycle to what we've seen in previous economic cycles. Normally, we're only just starting to see the consumer coming back into the fray about this point in the cycle. But as you've said, the consumer has actually been leading the charge in this recovery. And the last quarter's numbers were a total blinder. 6.6% annualized consumer spending growth. We had 25% annualized consumer durable growth. Now that clearly is unsustainable in my view, and we're looking to see the fourth quarter in the US annualized consumer spending drop to something in the region of around 2% or 2.5%, something like that. So certainly we can't expect to see this 6.5% continue, I think, going forward.
Why the bearish consumer outlook? Are you saying everybody is going to max out their credit cards this holiday and have fun and a Merry Christmas with silver bells and everything? Then they're going to get their bills in January and they're going to get sticker shock?
Well, I think basically you've basically used up any potential, what you might call pent-up consumer demand, and particularly in areas of the consumer goods side, the durable goods side, rather than perhaps the non-durable goods side. But where I think you will see potentially the pickup is in CapEx, and particularly in IT CapEx, where we're seeing that picking up at around 8.5% to 9% on an annualized basis. That actually looks quite good. We're also seeing a big rundown in inventories. Inventories in the US are at a 38-year low in relation to sales. So producers are scrambling to cover this. So I think what we're going to see is a producer-led recovery perhaps in the next quarter rather than a consumer-led recovery.
Just sticking with the retail sales element there, Peter, though, all this spending is coming from debt. I mean, it's coming from fresh borrowing. So we can sit there and say, okay, the debt situation in the US is not a problem, because what we should be looking at is the servicing costs of that debt rather than the absolute level of that debt. But here we are in a situation where interest rates are going to go up. Let's make no bones about that. It doesn't matter when, they're going to go up. And when they do, the ratcheting up of those repayments is going to become quite ferocious, is it not?
Oh, absolutely. The U.S. economy is very, very vulnerable indeed. As you know, the the household debt service ratio is now running at about 14% of household income. Normally it's around 10 to 12%. The actual private sector savings ratio in the U.S. is running at about 4%. Normally it should be around 7 to 8% at this time in a cycle. So certainly this economy is very vulnerable to any kind of shocks. On the interest rate front, though, I think the Fed has got good grounds to hold its ground on interest rates over the course of the next 3, perhaps even 6 or 8 months, because of the weak inflationary figures that we're seeing. We're certainly not seeing any pressure on CPI, and the Fed has targeted this 1 to 2% range. We're comfortably within that range at this moment. So I think the risk of Fed tightening is actually quite slight over the course of the next 6 months.
Seems like there's a bit of a window of opportunity here before rates do go up for people who haven't yanked whatever equity they have left in their homes out of their homes. Could this be, could that be the source of one last hurrah in the markets to kind of recharge their coffers by looking inwards toward their humble abodes?
Well, Absolutely. As we all know, the refinancing of homes has been a major pillar of the consumer over the last 12 months or so. And I think that's absolutely correct. There may well be another final round here if people are looking to see an expectation of Fed tightening over the course of the next year or so. Then I think you may well see people take this opportunity to top up in this way. But of course, bear in mind already mortgage rates are rising because they're funded off the long end of the curve, not the short end. So they have already risen. But if we see any expectation of Fed tightening, that's going to rise even further. So already in the last 3 months, refinancing your home has become a little bit more expensive than it was 6 months ago.
Well, while we're talking about Fed tightening here, Peter, let's return to what has recently become quite an unfashionable topic of conversation, which is the deflation argument. Now, a lot of people were quite surprised about the length of time with which the Fed harped on about potential disinflation, as they called it, while everybody else was saying, look at the kind of stimulus that's going on, let's talk inflation. Are we still in a potential deflationary scenario? I mean, we were talking off air just then about the supply that we see in the United States. I mean, you can buy almost anything anywhere for a fraction of the price that the sticker says on it. The supply of goods there is still enormous. And again, coming back to the retail sales element, a lot of the gains in the retail sales are going to the discount stores. They're not going to the top line models, are they?
Absolutely. I don't think we've got away from the disinflation story at all. And that's very much, I think, central to my argument that the Fed will remain on hold for the time being. There are still huge risks of shocks to the U.S. economy. Just imagine if we had a spike up in energy prices or an extraordinarily cold winter with a rise in demand for gas prices, etc. That would act as a significant tax on the domestic economy. We've got these very high household debt levels and borrowing levels. So the economy is very vulnerable, and I think the Fed is very aware of that. And I think the risks still, I think, on the disinflationary side rather than the inflationary side at this point. And bear in mind, the world is totally awash of capacity right now in just about anything you could care to name. And of course, China is a focus of that excess capacity. So I can't think really that there is any great inflationary pressures here, and there is still big risk to the downside in the US through these shocks.
In which case, what is the way forward, Peter? I mean, what we've got here is potential disinflation and no ammunition left to fight it. If we don't see something coming on the positive side that is more than simply more of the same, where are we going to get the next boost of stimulus from?
Well, we've still got another round of tax cuts coming in the first half of next year. We've also got, if you think about it, something like 30% of household income, or private income, sorry, in the U.S. is driven from things such as government handouts and dividends and so on, and they're up 5%. We're going to see another round of dividend payouts coming through. So you've got quite a big, what you might call non-core income that's actually kicking in, and I think we don't tend to focus on that very much. But you're absolutely right. We're not seeing a lot of pricing power in most kinds of industries right now, but what we are seeing is good operating leverage as we see demand kicking back a little bit, pulling back. We are seeing operating leverage coming through in the corporates, and that's being thrown up into quite decent earnings growth and dividend growth and so on. So I think that's where we're seeing, in the short term at least, the potential for income gains, not so much from what you might call the core wage employment side, but really from these non-core aspects of income.
All right, Peter. Don't go anywhere. We're going to have to sneak in a quick break now, but we'll come back, and I want to pick up on the point that you mentioned there about China and its production. We'll pick that subject up in a moment. Stay with us. We're back in a couple of minutes. Let's turn our attention back now to our Hong Kong studio. Peter Churchouse, Advisory Director with Morgan Stanley, is standing by for more words on the state of the global economy. And Peter, before we went to the break, we were talking about the impact of China and its production on pricing power in the United States and what it's doing to the global economy. And I just want to pick that theme up with regards to the employment picture in the US. You know, everyone is blaming China for stealing manufacturing jobs from the United States, and there is truth in that. I mean, it's not necessarily to blame for the budget situation or the trade situation, but it is taking away some of the jobs there. I just want you to analyze that from the status, from the situation of what are the US jobs that are being created now? Because if the manufacturing jobs are going and all the jobs are in the service sector, is the average wage in the States going to start declining?
Well, of course, China is not only taking jobs away from the US in the manufacturing sector, but it's a global phenomenon. It's taking away from Malaysia, even from other Southeast Asian countries, from Europe as well. And that's going to continue when you've got 200 million underemployed or unemployed workers in a country that can drag in a savings rate of 39% and $57 billion US a year of foreign direct investment to build factories. You're inevitably going to run up against that problem. So it's not a problem that's just in the US. This is a global issue. And
right,
in terms of...
I just want to interrupt
sorry,
for a second, Peter.
My earplug keeps coming out.
My point here being simply that people are saying, look, we were seeing a pickup in temporary employment in the States. This is a precursor towards there being more permanent jobs being created. And I'm wondering if that link is maybe becoming a little weaker these days, because, like I say, the status of the jobs that are being created, there was a study that came out only yesterday suggesting that these jobs are in service sector areas which are being relentlessly downsized in terms of the amount of wages they're paying. These people are working 39-hour weeks in order not to qualify as full-time jobs. That whole service sector economy that's becoming such a big part of the overall is actually an area where there's no unionization, there's very low wages. I'm just wondering if this is actually going to be an impact on the economy.
Well, you've got service jobs and you've got service jobs. You've got the burger flipper type of service jobs, and you've got what I might call the knowledge jobs and the professional services such as insurance, finance, banking, fund management, telecom, and you might even talk about sort of R&D kind of jobs. Clearly, that's where the U.S. competitive advantage is, and the U.S. has to move very much into those kinds of jobs. So I've got to think that's where the U.S. has to focus and really just move away from these subsidized steel jobs and this kind of thing.
Yeah, I mean, there was also the report from the Haas School of Business at the University of California that came out last week saying that potential 15 million jobs will go to India in exactly the sectors you mentioned, those very high-paying areas of work. Peter, we'll take a break now. I'll let you fix your earpiece for the moment. Peter will rejoin us at the top of the hour after this. We'll take a short break now and come back with more. Stay with us.